My name's Mark Cormack. I'm a director with Pinnacle Investment. It's great to be back with the Plato team to discuss Australian Bank's November reporting season and their dividend analysis. Today, I'm delighted to be joined by Dr. Peter Gardner, Senior Portfolio Manager at Plato, whose primary responsibility is managing the Plato Australian Shares Income Fund. Look, Pete, thanks for joining me.
Thanks for having me, Mark.
Look, let's get straight into it. Hot off the press today, ANZ reported it looked like a pretty complicated results with the integration of the Suncorp Bank and a lot of cost cutting. What were your views?
Yeah, it definitely was a messy result, and you saw that in the market reaction. It was initially trading down a couple of percent on the result, and then last I checked, it was up a couple of percent. So, yeah, the market's definitely digesting it at this stage. So the earnings, when you look at the headline numbers, are actually earnings were down 14%. But when you took out a lot of the significant items, the cash earnings are actually flat. Now, the new CEO is making a lot of changes there. There's been a lot of cost cutting going on. And so the market is generally like that, and ANZ's been trading pretty well on that, getting back to the kind of basics of banking, taking out a lot of costs. So overall, kind of when you look at their results, the dividend was flat on last year, which they had pre-announced, which equates to a 5.9% annual gross yield. So that's still kind of trading above market where the market is at the moment. Payout ratio is around 74% of those unadjusted, well, the adjusted earnings, so taking out the significant items. Their net interest margin was down slightly over the half, so not much going on there. But the big thing that I guess the market is liking is the fact that they're expecting $800 million of cost savings. So that's pretty significant when you're looking at the cash earnings of 5.8 billion if you're taking out $800 million of costs and also $500 million of synergies coming from Suncorp merger. Loss rate was 7 basis points. So that's the kind of bad debts, which was actually doubled from last year, which was slightly surprising, but it's still at pretty low levels. And I'll show you the kind of Westpac and NAB ones later on so you can compare.
Okay, NAB reported last week, looked like a flat result, some higher bad and doubtful debts. What were your thoughts?
Yeah, so NAB result was disappointing. So we kind of had the messy result from ANZ, the disappointing result from NAB. And that was disappointing just in terms of what the market is expecting, because NAB is trading a bit of a higher multiple than ANZ and Westpac. So it's priced that its earnings should be improving, and you saw these earnings are actually down 0.2%, so basically flat on last year. The dividend was also flat, which equates to a 5.7% annual gross yield, so slightly more expensive than ANZ. The payout ratio was 73%, so again, similar to ANZ. Net interest margin rose 8 basis points, so that was the kind of good news. Their CET1 ratio is slightly lower than the other banks, though. And as you said, the bad debts were the disappointment. So that was up at 12 basis points compared with ANZ's at 7 basis points. Now, they didn't mention in the call. I suspect this could be because they've got a higher exposure to the Victorian economy, NAB being based down there, and particularly Victorian businesses. They kind of highlighted in the result there are a few kind of one-off things that caused their bad debts to increase. We'll see if that continues going forward. But yeah, I suspect even the Victorian economy isn't quite doing as well as the rest of the country. They might be a bit more exposed to that, which kind of caused a bit of disappointment there.
Okay, Westpac also reported last week. It seemed a better result in line with expectations, and they also had a dividend increase. What were your key insights?
Yeah, so Westpac was the good results of the bunch. They actually, one interesting thing coming out of Westpac is they're poaching quite a lot of staff from CBA more recently. And CBA has obviously been the best performer in the banks in terms of not just the price, but also their kind of earnings trajectory. And I don't know if that's starting to improve the way Westpac's being managed going forward. So their result was also down 1%. So very similar to all the banks. All the banks had kind of normal results, pretty flat with last year, but Westpac is a bit cheaper than is NAB, and they were able to increase their dividends by 1 cent, which equates to, again, a 5.7% annual gross yield, so similar to NAB. Their core net interest margin rose 2 basis points over the period, which is actually pretty good. And if you look at their CET1 ratio, it was 12.5%. So comparing that with NAB's on 11.8%, they've obviously got a lot more kind of room to pay out some of their earnings going forward in the form of higher dividends. And their credit impairment charge was kind of positive. It was only 5 basis points, so much better than ANZ and NAB's.
Okay, finally, investment bank Macquarie reported last week, clearly a disappointing result. The stock was down, missing market expectations, although the dividend was higher.
Yeah, so Macquarie is always kind of complicated in terms of a lot of different things going on with there. They rallied a bit in October because they'd announced that they'd sold some data centers, which is going to result in increasing kind of performance fees going forward. So we are expecting this to improve over time, but the negative coming out of this result was that they had to write down some offshore wind assets. So I'm guessing kind of with the new Trump era, potentially offshore wind assets are less in demand in America. And so they had to write down some of those, which actually caused their operating profit to be down 21% on the second half. It was actually up kind of 3% on the first half of this year. And so it wasn't kind of a terrible result in terms of where it's going, but it was a little bit weaker than the market expected. The other weaker part of the result was from the commodities division, which I guess there's a bit less volatility in commodities this year compared with prior years going forward. But given their guidance, they kind of pretty much maintain their guidance going forward, and an improvement in their asset management division, which is driven by that kind of performance fees they're expecting going forward. And as you mentioned, their dividend was able to increase 8%, so that's always positive. They've got a 64% payout ratio, so slightly kind of lower than the other banks, but still, yeah, they're getting up there in terms of payout ratio.
Look, thanks, Pete. Look, assessing the differences in Australian banks' results is a great example of how you need to be active when investing for income, especially as the market is always dynamic. And importantly, Plato shows there is plenty of income out there in Australian equities. You need to be tactical, nimble, and know where to look. And as a reminder, the Plato Australian Shares Income Fund has delivered over 9.5% per annum income since its inception. And importantly, it's also outperformed the index on a total return basis. Now, if you are after any further information on Australian equity income investing, please do not hesitate to contact the Pinnacle distribution team or refer to the Plato website, www.plato.com.au. Thanks for listening and have a great day.
Thanks, everyone.